I've been in small business lending and growth for the past 15 years. I founded Integrated Business Financing, and then I also have a factoring company called Integrated Factors. I've owned a gym, I've owned a medical business. That business was taking off. My mission is to help small business owners grow, because when you impact the business owner, you're helping his employees, their families, and that community that they serve. Business is all about cash flow. The better the cash flow, the safer the business is. The better the cash flow, the faster you can grow.
Like, what are the biggest things that people can do to start, establish, and then build business credit?
You need the business address, business phone number, a business email. You need a business bank account. Once you have those 4 things, then you need your business website.
What's the biggest difference between a business loan and a line of credit?
A line of credit gives you a max amount that you can draw over a set period of time. If you don't use it, it's still there, it's still available. A loan has a defined amount that you're getting up front, a defined monthly payment, and a defined interest rate, and a defined use.
Further talking about financing, what numbers should a contractor know before even applying for that?
Write this shit down. Is you need to keep anywhere between 10 and 20% of your monthly sales average in your income account at all times. The biggest thing, if this audience gets anything from this, is you should always finance things over its expected use.
All right, ladies and gentlemen, welcome back to another episode of the Trade Ops Radio podcast. Today, we're joined by Jonathan. For those of them who don't know who you are and what you do, if you could just give us like the quick intro, explain kind of your business and how you guys help people.
Thanks for having me, guys. So I've been in small business lending and growth for the past 15 years. I founded Integrated Business Financing. That is just a marketplace that connects and helps clients get the best financing possible. So from SBA loans, lines of credit, term loans, invoice factoring, equipment financing, project financing, like you name it, we carry it. And then I also have a factoring company called Integrated Factors. Those are really my 2 flagship businesses. I've owned other businesses. I've owned a gym, which was terrible. I've owned a medical business that the government basically recently, as of January, shut down because they stopped how it was getting reimbursed, which was awful because that business was taking off like in a meaningful way. And yeah, that's it. And what do I enjoy? I live in Tampa. I love God. I love my family. I love playing hockey. I love teaching kids how to play hockey. And what I really enjoy, my mission is to help small business owners grow, because when you impact the business owner, right, you're not just helping that guy. You're helping his employees, their families, and that community that they serve. So everything I do is focused around that lens.
Right on. Awesome. For our clarity and also for the audience too, can you just explain a little bit more the difference between the marketplace and then the other side of that, the factors business? Because those are words that, especially the factors piece, those are something that a lot of guys maybe have no clue what you're talking about. So explaining it to like an 8th grader, how does some of that stuff work, the terminology, and then also the difference between what those 2 things do?
Absolutely. So with Integrated Business Financing being a marketplace, what we're doing is we are bringing in a client. We're analyzing his application with him, right? We have all the same software as the banks use. And then we're partnered with, I don't even know how many different financial institutions, but basically almost all of them. It feels like sometimes. And so we're connecting that entrepreneur to the right program based on what he's trying to accomplish. With Integrated Factors, that is just us helping people speed up their accounts receivable, right? Or doing invoice factoring. And that is on my balance sheet. When I say balance sheet, it means it's my company's money that is getting lent out through myself and a warehouse facility. And a warehouse facility being a bank, larger bank that is supporting a smaller financial institution, myself. Does that make sense?
Yeah, on the factors thing, like just so I fully understand it, is that where it's like, hey, I have a pending invoice. Can I give you that invoice to collect the payment for it? And then you guys hold that outstanding accounts receivable or whatever? Okay,
That's
gotcha.
awesome. That's exact. So I'll tell you how it works. Let's say someone has a $10,000 invoice, right? And it's going to be out for 30 days.
Yeah.
The problem with that is you laid out the money for the job.
Yeah.
Right? You laid out the materials, and now you're waiting to collect. And so if you're growing, you don't have the money to take on the next job or 2 jobs. If you set up invoice factoring, you can actually get paid same day you are done with the work and you send that invoice. And what that does is it allows you to grow much faster, borrowing money, let's say from a line of credit, because a line of credit isn't going to fix it. A line of credit's going to fix it in the short term, but then you have that payment. And so the way invoice factoring is structured is if you send in that $10,000 invoice, we typically give 80 to 85%. So let's just say 8,500. You get 8,500 the next day. We hold 1,500 in reserve. Your client pays us. We release that reserve minus a small fee. That small fee usually is only 2 to 4% per 30 days. So it's not cutting into margins. If you think about using a line of credit, you might have a line of credit that has a draw fee of 2 or 3%. So you're already way more expensive. Plus, it's not pay when paid. You now have a monthly payment, and that's taking away from your cash flow, right? Business is all about cash flow, guys. The better the cash flow, the safer the business is, the better the cash flow, the faster you can grow.
Sure. Totally get that. And, you know, speaking from experience, I've owned and operated home service businesses in the past. And when we started working with like pretty sizable commercial accounts, they always said they were going to pay net 30 on the invoice, and it always ended up being longer than that. And when we started taking on some of those bigger accounts, a lot of times, like a lot of home service guys probably experience, it's like the beginning of your season is you just survived the winter or your slow season. So you're already strained for like cash reserves. You don't have a lot of working capital. You haven't had income, or like you haven't been producing revenue for a little bit. So you're already stressed. And then you start to do all these big commercial jobs. You front the bill for that, labor, materials, all of that stuff. And then you're getting paid net 30 plus whatever corporate paper pushing and all that other shit that adds time after. So it's like, yeah, when I was in that position, it was like basically 2 to 3 months of us, you know, really, really struggling to keep everything going because we footed the whole bill for everything. Once those checks started to hit on the back end, it was great. But thinking back to the amount of stress and then also the amount of additional cash we probably could have produced if we weren't trying to play conservative because we were strained on the cash flow side, we could have outpaced growth wise whatever the 2 or 4% we would have paid to have that money now. So I totally can see how this is the right fit for people that are in that position. And like, as long as the numbers make sense and they know their numbers, like, yeah, it can definitely kind of help you, like you said, accelerate the growth and keep the cash coming in how it needs to in order to kind of stay on track with, you know, your projections and keep overhead and all that shit kind of managed. So
think about these two things too. One, you know what you're paying for that float, right? You can bid that plus into every job. So if you know you're at 2% per 30 and your average client's paying in 30 days, just increase everything by 3 or 4%. No one's going to feel that. No, that's the first thing. The second thing is, how many times have you guys taken on a job or heard someone take on a job with almost no verification, and then they get either paid slow or they don't get paid? I actually just did a live on this, something that nobody understands about invoice factoring. Invoice factoring will underwrite your clients for you, meaning when you send in a contract or when you are sending in your clients, we can pull their business credit. They don't know we're pulling their business credit. And we could say, hey, Yash, you have a $200,000 contract with ABC Co. Well, they're approved for, let's say, $500,000 in business credit. Take all the work you want from them. Or you send us a $200,000 contract, we pull it and say, hey, these guys aren't approved for $5,000. You need to run. Don't walk, run away. And you'd be shocked. Like, our hit rate on that is very, very, very high. So yeah, it's a great program for that.
Something like that, I don't think the average home service business owner either A, knows exists, or 2, has the resources to do on themselves. I've never heard of something like that. That's a really, like, especially for guys that are doing commercial work with bigger entities, like that is That's actually pretty awesome. That's cool.
And think about this, like Chicago, Chicago's run terribly, right?
Sure.
But if you are a contractor, and that's not meant to be a political statement, right? You could say the same thing about Minnesota or certain other states. You think you're getting a great contract because you bid on a school system. Guess what? Some of those school systems are flat out broke, like about to go bankrupt. So you might take on that job and you think, hey, this is a home run, and then you're not getting paid.
Yeah. I think it's definitely easy to fall for the allure that because you're working with state or government funded things like that, you're guaranteed to get paid. And it's like you said, those
Yeah.
guys are businesses too, whether they see it like that or not. And some of them, a lot of times, are not managed or run like proper businesses. So you don't know what kind of problems they got under the hood. It sounds sexy to be like, oh, we do the work for all the schools in the area. But at the end of the day, if it don't make sense, it don't make money. So yeah.
And interestingly, this happened with one of our clients based in Arizona. So yeah.
Oh, really? I'm
Yeah.
sorry to hear that. I hear it a lot though. Like it's not. I had one guy, and the reason I even brought it up is because I had somebody that went totally dark on us. We were working towards a term sheet for him. He just stopped responding. This was about 3 or 4 months ago. I saw that he posted in a group that we're both in, hey guys, never worked for this company. They owe me like $70,000. And that's like half of a month's worth of revenue for that guy. That's a tough hit. And had he actually sent in everything, he would have never taken on that job because we would have told him, hey, these guys don't pay anybody.
Yeah. The ability that you guys have to eliminate a ton of risk and even save, like it really, really sucks because you cannot explain fully the value of what you guys are offering to someone that hasn't been burned as badly as some of these people have. Like it's one of those things where it's like you don't know that you need it until you have a really, really shit experience. And it's like after that, you would never not do it again. But yeah, I hope anyone that's listening to this that is in the process of, getting set up with some commercial or stuff, or is pumped about this big job that they got going on. Like, dude, there's so many ways that you could get fried on that deal that maybe you're not on your radar and you're just excited and the carrot's been dangled. Oh, this is a huge commercial account. We're going to make so much money, blah, blah, blah. And it's like, all right, pump the brakes a little bit. Let's actually make sure that this ends up working out for everybody. So yeah, that's huge, man. To kind of just like give the audience, which would be primarily like home service or like HVAC, plumbing, electrical contractors, some context on like how they can get into doing stuff like this. I think we covered kind of like what it is and how it's valuable for them. If we can dive into some of the stuff that's like, what do they need to qualify? What are some of the things that they should have set up before, contacting you guys or getting involved with some of this kind of service? So first kind of question, we'll kind of like, I got a couple that are kind of going to hopefully flow in order of like operations of what they need to do to kind of get everything put together to work with you guys or do something kind of like this. But first things first, like a lot of contractors are used to just, they pull from their own cash or personal credit. Why is that leaving money on the table or potentially a big mistake compared to doing something business funding wise or like something that you guys do?
It's problem is this. When you pull from your own personal cash or your own personal credit cards, you have so many limits on that, right? And so think about it. And I always tell people, build your business credit. It's a foundational piece of your business because you want to separate your business and your personal as much as you can. When you're putting everything on your personal and something goes wrong, what people don't realize is if it's all reporting to you personally, you have high revolving utilization, which means your credit score is going to be lower. All right. And so like it's the equivalent of like somebody having a low 600 credit score, but they constantly are paying everybody. They don't miss payments. It's just that they're using too much of their own personal credit. And so then when you come to anywhere for lending with a low 600 score, it's going to be much harder to get into a good program. Does that make sense? So
Yeah.
have to set up the business the right way. What I would suggest is build your personal credit, build your business credit. I did a whole show on building your business credit, so you don't have to pay some guru $5,000 or $10,000 to do it for you. Just listen to that, follow the basics. And by the way, guys, if anyone's telling you, hey, you could get a $50,000 no doc loan just off your business credit, that's bullshit. Okay. Don't do that. If it seems too good to be true, it is. And everything that you want to accomplish in your business, this is huge. There's a tool for it, right? If you are an HVAC company, you don't go to a service call with just a hammer. Why? Because you're probably going to need a lot more than a hammer. Same thing with anything that you're trying to accomplish in your business. Banks really don't carry all the programs. You have to understand, hey, this is the specific goal that I want. If you need a piece of equipment, it's equipment financing. If you are growing and you need to, and you're in commercial and it's what's killing you is waiting 30 or 60 days to get paid, you need to set up Invoice factor. If you're taking on a large project that you truly don't have the money for, because let's say you're a guy that's doing $200,000 jobs and somebody floats $1 million job in front of you, well, guess what? You probably don't have the cash in the bank to get that started. That's project financing, right? That's contract-based financing. All right. There's something for everybody. You need to use the right tools. What happens is if you use the wrong program, even though it might work in the short term, in the long term, it's going to backfire.
Yeah.
Right.
Don't try to pound in a nail with your skill saw
Yeah.
type of deal.
Correct.
Sure.
Absolutely.
I know you said you did a whole like kind of masterclass on how to improve your business credit. At the end of this, send us a link to that and we'll put it in the description for guys that want to check that out. If you could give us like the 60-second or like the highlight reel version of that, like what are the biggest things that people can do to start, establish, and then build business credit?
Great. So you need 5 things to start. All right. You need a business phone number. It cannot be a Google voice number. It has to be registered to the business. You need a business address. It can be home-based. It cannot be a P.O. box. And by the way, guys, never put a P.O. box on any financial application. It's a huge indicator of fraud. Can't be a P.O. box. It can't be like a micro suite somewhere where you're renting a closet for $500 a month in Delaware. All right, because people do that. You need the business address, business phone number, a business email. What do I mean by a business email? It can't be Jonathan Funds Businesses at Gmail, right? It's Jonathan at integratedbusinessfinancing.com. You got to pay for the domain name. You need a business bank account. Do not use any of those fintech banks. If you can't walk into the branch and speak to somebody, you should not use that bank. Once you have those 4 things, then you need your business website. And everything, your business phone, business address, business email should be listed on that. That is what I call the 5 fundability factors. All right. That should be posted everywhere online. And then what you do is you go to dnb.com or Dun & Bradstreet. It literally is dnb.com. And you're going to search your legal entity. After you search your legal entity, and by the way, they're going to try to sell you. Do not go to NAV, because if you go to nav.com, they're going to pull your information and they're going to sell it out to a bunch of brokers that are going to sell you cash advances. All right. So you go to dnb.com, you claim your profile, you enter all that information, you get your DUNS number. And then what you're going to do is you're going to go out and apply for like very, very easy business credit. Think Home Depot, Lowe's, Staples, Best Buy, Uline. And the way you do that, you don't put your social on it, you put your EIN on there. And they're probably going to start you off at, let's say, a $500 limit. You use it, pay it back. Use it, pay it back. That's like the very, very basics of building. I go into a lot more detail on the podcast. I also, on any of the other episodes, all I talk about is growth strategies and finance strategies. And I tell you guys like it is, not like theory like you see online.
Sure. I think that right there is perfect for our kind of audience. If I can be selfish for a moment and ask you how that would work for someone like us who run a digital business, where it's like we still want to build credit, but we don't buy stuff at Home Depot or Lowe's. Like what can we do to build our credit in that regard?
I mean, you buy office stuff, right? So you got Best Buy, you got Uline. You can do that. Then you could open up business cards, any type of equipment you could finance, right? So if you have a lot of computers, you're building out a podcast studio, right? That's all stuff that can get financed under the business. Any vehicle can get financed under the business, right? Those are all things that you can do. And now think about it. There are businesses like business credit helps you separate business and personal. Believe it or not, if you're in the trades, let's say you're going to work for municipalities, they will actually check your business credit. If it's not high enough, they won't let you or they'll limit what size jobs you can bid on. Okay. And what it really helps with is like SBA loans, it can help you with. It can help you with equipment financing. It can help you get better terms from your suppliers and your vendors. All right. But if you're like an information business, is it the end of the world if you don't have it? No, it's not. But it is very helpful to set it up, and it will help you in the long run. The other thing I tell people is, look, if you had business A that did this and business B, and everything was the same, except business B had established business credit and business A didn't have business credit, which one are you more likely to want to purchase?
The one with the business credit.
Correct.
Yeah. I was going to say, we've had a lot of conversations with not only HVAC business owners, but business brokers, and then also people that do like private equity investing and stuff like that are buying and selling these businesses. And we've asked the same question a million times just to try to get everybody's perspective on it, as far as like, hey, what can these guys do to prepare to sell? When you're buying, what are the things that you're looking for? Green flags and red flags. And it's interesting. I don't think credit has ever come up, but it's definitely a factor where, like you said, if it's a difference between two businesses that look identical on paper, and then there's the only factor left to determine which one you're going to purchase is what's their credit. I mean, obviously it doesn't make any sense to go with the one that's less, right? So that's interesting. That's a first time I'm hearing that, and it certainly checks out and makes sense. Is like on our bulleted list of things we'd be looking for when acquiring, like that's in there for sure. So
Well, think about this, right? One guy has no terms with ABC Co., right? That's a big supply house that does a lot of different stuff. The other company has 60-day terms. Who do you want to pay cash, or do you want 60 days to pay whatever the for the materials that you need? It's not even close in my book.
Gotcha. What's the biggest difference between a business loan and a line of credit, and which one makes the most sense for home service businesses?
Great question, but it neither makes sense without context. Okay, and let me explain. So a line of credit gives you a max amount that you can draw over a set period of time. Think, let's say you have a 24-month line of credit and the line is $100K. All right. All that means is you can draw up to $100,000, and whatever you draw is going to be scheduled to pay off inside of 24 months, unless you pay it off early, right? If you don't use it, it's still there, it's still available, and you're not paying on it. If you only draw 50,000 of it, you still have 150,000 available. And as you pay that 50 back, more and more becomes available. So it's more flexible, and a line of credit is designed for short-term, everyday things, opportunities, emergencies, and like, let's say marketing, adding to your team, supplies, materials, any of that stuff. A loan has a defined amount that you're getting up front, a defined monthly payment, and a defined interest rate, and a defined use. So if you get a $100,000 business loan, you're paying back that monthly payment. You have no ability to go in and redraw more. You took the 100 and that's it. It's final, right? So to say which one is better is bogus, not because it's a bad question on your behalf. It's because If you're going to get equipment, right, you want an equipment loan or a lease with a dollar buyout. All right, because you're going to finance it over 3 to 5 years. If you're using it for short-term everyday things, you want the line of credit. All right. And I feel every business should have a line of credit, but one caveat to that, if you are B2B or B2G and you're more concerned about your cash flow and invoice factoring, you have to set up invoice factoring first because of how the liens work. Invoice factoring has to be in a first position UCC lien on the business. After invoice factoring is set up, then you can open up a line of credit for those short-term things. What you should never do is use a line of credit to float AR because it doesn't fix the problem. All right. And I'll break down the math on that in a second. Let's say you have a $100,000 line of credit and you're using it as you're growing, okay, to take on the next couple jobs. Well, it doesn't fix the problem of you waiting to get paid. All it does is add a payment, a monthly payment that takes away your cash. All right. It's like going to the doctor and you have some type of chest infection and you're coughing and they give you cough medicine. It's not taking away the infection. The infection's still there. Right. Well, when you do that with a line of credit, what you're doing is you're hurting your cash flow with that payment. And eventually you're going to max out that line of credit and you're going to be in a worse position than you were before. Whereas if you set up invoice factoring first, now you're no longer waiting to get paid and you can use that line of credit how you should, right? To add people to your team, for marketing, for like those short-term things. The biggest thing, if this audience gets anything from this, is you should always finance things over its expected use, okay, or life. Meaning there's a reason when you go and buy a house, you're paying for it for 30 years. All right. When you buy a vehicle, you're typically paying for it in 3 to 5 years, or equipment. When you're doing things like adding somebody to your team, marketing, getting inventory, that's stuff that you do every day, every week, every month. All right. So the idea is if you use a line of credit for that, you can use it, pay it off, use it, pay it off. Whereas if you're getting a loan for that, it doesn't make sense to finance that over, let's say, 3 years when you're going to need to do it again in 2 months.
Yeah, that makes complete sense. That's a gem. I totally understand what you're saying too. And with the invoice factoring stuff too, the not actually addressing the problem with the invoice factoring, and correct me if I'm wrong here, because I don't want to spread misinformation, but this is just me trying to like repeat back what you were saying so I understand it fully. With the invoice factoring, you're paying based off of a percentage of what the amount of money you're going to get to basically accelerate it and put that money into your account today. If you were to try to compensate instead of doing that, but doing with a line of credit, you're basically taking out a line of credit to float whatever expenses you have for the business instead of getting the invoice money paid right away. And even if the percent that you're paying as far as the line of credit or the invoice factoring is identical, you're still creating another payment by doing the line of credit. Whereas with the invoice factoring, once the money gets put into your account and then whatever's left over, like you're not creating an additional payment after that for yourself. So yeah,
So the easiest way that I could break that down for the audience, because you're right, but this is what effectively you're saying. Invoice factoring is pay when paid. Okay. Project financing is pay when paid, meaning your company doesn't have a bill, okay, until your client pays. And when he pays us and the bill's done. And then, in fact, we send you the difference between that fee that we charged you and the reserve we were holding. All right. With a line of credit or a loan, you have a monthly or weekly payment depending on what type of structure you did. And that is drawing from the cash flow. Whereas if you use a pay when paid program, you're good. So think about it like you're just matching the payment terms. Okay. So technically, when you send an invoice, yeah, it's supposed to be due in 30 days, but sometimes net 30 really means net 45. All right. And it's still pay when paid. Well, why would you use something with a defined structure like a line of credit or a loan for a paid when paid thing? You have to match the financing to the challenge, right? And to what you qualify for.
That makes sense. I visually in my head, I totally understand and I can see the differences. Not the best at explaining it, but that's why you're here to to fill the gaps and give us the good stuff. So I appreciate that, man. That's huge. Understanding the difference between those two things for sure. Thank you.
And further talking about financing, what numbers should a contractor know before even applying for that?
Applying for any program or just a specific one?
Right now, I would say probably any program
Okay.
that's
So-
suitable for that specific, thing.
Got it. I'll break this down for you. 90% of all underwriters look at the same stuff. All right. I'm going to give you guys the test questions. And if you know the test questions, that means you can ace the answers. All right. So everybody looks at credit. When I say credit, I mean business and personal credit. All right. Even if I finance equipment under the business, we still look at personal credit. If I do an SBA loan for a business owner, we're still looking at personal credit and business credit. That doesn't mean it reports to personal credit. It means that's what we're looking at. Okay. The next thing is time in business. Why is this important? Well, it's important because it's not something you can really do anything about, but it is something that you can mess up. And a lot of people do this. So instead of changing your legal structure or your EIN, do a DBA change if you're going to change the name. Okay. Because anytime you do anything with the legal status, you're resetting your time in business. And time in business is a critical piece to an underwriting decision. Believe it or not, factoring, it really isn't so much, depending on, what work you're doing and the contracts. Like I've done it for startups, but for an SBA loan, for equipment financing, it's very, very meaningful. All right. And so don't change the legal structure or the EIN. Next, they're looking at cash flow. But what is cash flow? All right. Cash flow is how much is going into the bank on a monthly basis. How consistent is it going there? Meaning you doing 200,000 each and every month, or are you doing 100,000 one month, 300 the next, then 75? Are you yo-yoing? Okay. Are you seasonal? Meaning, and everybody on that's listening to this should know what that means, right? Like you're probably crushing it in the summer, and winter might be a little bit more challenging. Well, if that's the case, we got to look at a full year of banks, right, to be able to analyze that. And it's how much is kept in the bank. My rule of thumb, guys, write this shit down, is you need to keep anywhere between 10 and 20% of your monthly sales average in your income account at all times. So if you're doing 200,000 each and every month, you need between 20 and 40K in that account at all times. They're looking at, are there negative days? Okay. They're looking at, believe it or not, especially with equipment financing, beginning and ending daily balances, right? Because most people either are going to pay at the beginning of the month or the end of the month. And if you're paying at the end of the month and you usually keep 40,000 in there, and this equipment that we're financing, let's say it's a ditch witch that has a $5,000 a month payment, and each and every month you're ending with 2,000, well, you might not be able to afford that payment. All right. So there are a bunch of different things that people don't consider. Even the number of deposits, right? If you're looking to get a line of credit, they want to see more deposits. More deposits mean more clients. More clients mean more stability, right? Think about it. If somebody's only having 4 deposits a month versus somebody that's doing 20, that guy that has 4 deposits each and every month, well, if he loses a client, he's going to be down 25%. Whereas the guy that it has 20 deposits, he's only going to be down 5%. He's not as risky to lend to. What else? Profitability. Okay. Especially when we're talking about equipment financing and SBA loans. And also, reporting. Okay. I'll get into this. The biggest holdup, the biggest reason why people get delayed for invoice factoring, for equipment financing, for SBA loans is they don't have this shit together. Okay. If you don't have an accurate AR, AP report, right? Aging AR, aging AP, that's problematic. If you don't have year-to-date financials or monthly financials, that's problematic. I will tell you that out of all the people I speak with, I have 2 bookkeepers I recommend, And I would say on about 40% of our intake calls, especially for invoice factoring, after we review their application, we are sending them out to work with an actual fractional or virtual bookkeeper or fractional CFO, if you will. All right. Why? Because they don't have the reporting set up. They don't understand it, which is fine. Like when you open your business entity, they didn't come and teach you how to use QuickBooks. They didn't teach you how to run the business, right? Half of us are just winging it. Trust me, I started that way 15 years ago. And you know what? It took me to probably year 7 to get my head out of my ass and understand like how to run a business. And that's a big deal. So that's it. If you're asking what makes a good borrower, it's having those 4 or 5 things dialed in, having good reports, and then we touched on business credit earlier, but believe it or not, some lenders look at reviews, they look at your online presence. All right. If something doesn't add up, they're probably not going to want to lend to it, right? Because it might be a high indicator of fraud. All right. And so, yeah.
It's interesting how, I mean, I don't know if we got into this, but we offer marketing and consulting services. And a lot of the things that you're talking about are the same things that we look at when we're determining if we want to bring on a client or not too. And, we're not looking at them for financial qualification, but they might as well be the same thing. For all intents and purposes, we're looking at like the legitimacy of the business and if there's potential, for us to come in, help them solve problems and grow. It's very interesting, like, not that we're a bank, but, with some of our services and the people that we're trying to work with, like we do our due diligence and it's the same kind of things that we're looking at. I wanted to backtrack really, really quick. I have 2 specific questions. So the AR and AP report, is that annualized revenue and profit or something else? I'm not familiar with that term.
Aging accounts receivable
Mm.
report. So that breaks it down from a current, a 0 to 30, a 31 to 60, and a 61 to 90 or a 90 plus, right? So that shows you who owes you money, how long they've owed it. Okay. With an aging accounts payable report, we are looking at who you owe money to and how long have you owed them that money. So if it's current, meaning you owe, let's say 20 grand, but you just sent that invoice, right? Or is it, does it fall in any of those buckets? And typically the rule of thumb is this: anybody that is 90 plus days old, when you send them in for invoice factoring, they're ineligible. Okay.
Yeah.
And that's like a big deal. So another thing is like, we want to look when we're analyzing those deals. Hey, is your AR larger than your AP? Great. Because that means that over the next, call it 30, 60, 90 days, you have more money coming in than you have going out. Yeah. Theoretically. It's not a lock, but that's theory. Okay. But if your AP is larger than your AR, well, you're going to have some turbulence, right? Some people might not get paid or they might get paid late. We need to know about that, right? Because we don't want to have any type of issues. So yeah, that's what that
okay.
is.
That gives me a much clearer picture. It's basically like, is your balance sheet positive or negative? Are you owed money or do you owe money? And at the end of the day, it's like, there's that perfect, like let's say it's perfectly balanced. The more you are owed compared to the amount that you owe, the higher you're going to qualify for anything lending wise and money wise, whatever.
But
that makes
sense. There also could be some like nuance to that too, right? So if you have a massive AR and some of it's like 60 to 90, like I've seen clients misrecord things. So it looked like there was some severe problems. And once we figured out, like I sent them to that bookkeeper, they taught them like, hey, you're not recording your AR properly. This is when and how you should record it. And we fixed it. So all that stuff really does make a difference and really does matter. Also, if you have a lot of AR that's aged out, it might not be and your clients have good credit. It might not be a client problem. It might be a process problem, right? It might be how you collect. What's your communication like? Are you sending the invoice once or are you follow up to make sure they have it? Okay. What are your terms? Are your terms clear with your clients? if those guys are going and they're waiting to the 30th or 60th day when it should be on day 30, well, why aren't they getting a call on day 31? Because as an invoice factoring company, that's not, that's not really our job. We'll let you know, hey, like these guys are now, 31 plus or 60 plus, because that's going to cost you more money,
Yeah.
right? But you need systems to bring that money back in.
Right. And also for you guys, essentially, like that's the risk that you're taking on as well, right?
Yeah.
Like holding the piece of paper that potentially doesn't get paid if
No, no,
that
no. Like
business or
if
that
it
system.
correct, like here's the thing: if it goes 91, once it goes 90 plus, unless it's we do work with a couple companies that they have net 90 terms, like a lot of the larger ones, and so if it goes, we know if we know it up front, it's not a big deal. But if like your average client goes past 90 days, they're automatically ineligible, and you have to either settle that up or buy it back. You might settle it up out of another invoice, and now you have to go chase that guy down and collect from him.
Hmm. Yeah, I can see how primarily for most people it's probably a systems issue. Like it's hard for me to imagine the world where that's the norm unless you're dealing with like huge corporate accounts, right? Like for guys that are out there doing residential HVAC repairs and installations, like I don't see any reason why you should be taking more than 90 days or even more than like 30 to get paid on like worst case scenario, right? A lot of them are trying to get, full payment after service is completed. Due on completion would be ideal, but I don't understand like sometimes it doesn't always work like that. But yeah, hard to think of a situation where if you're getting paid after 90 days, it's not going to create massive problems for your business. So yeah.
What was that second question?
Yeah. You mentioned B2B, which is obviously business to business. I'm familiar with B2C as well, but you said B2G. What is that?
Business to government.
Business to government. Okay. That makes
So
sense.
invoice factoring cannot factor consumer accounts. It cannot go against residential properties. Okay, it can do like, let's say, a multifamily. Most people don't realize that because a multifamily is typically owned by a corporation. But
Clear.
you can't do like roofing or insurance. It doesn't work for invoice factoring unless it's commercial.
Okay. That makes sense. I think that clarifies a lot as far as if there's someone listening to this that's thinking about, oh, that might be something we could use. I think that further clarifies the people that actually benefit and qualify to use that kind of service. That makes sense.
Yeah, I
Um,
mean, what I would say is just if you have questions, reach out. We'll walk you through it. We'll figure out the right program and get you squared away because what we do is a lot different. I wish I could show you guys here, but it's got people's personal information. But when anyone comes in, we do a soft credit pull, personal credit. We do a soft business credit pull. We put all of their statements through a cash flow analysis that the banks use, and then we shoot it back to them in an Excel format. And we basically show their business the way a bank is looking at it and in a way they've never seen it before. And so we review what's good, what's bad, how we would improve it. And then based on that conversation, we go out and find the right options or right programs. We bring them back and then they pick. So we're not, are we like a bank? Yes and no. Right. But we have a very, very high touch point type of process where our clients stay with us for a very long time because we really are guiding them. We don't really charge for the consulting piece. All right. As long as you're working with us for whatever you need, we're not going to charge you the consultant piece, but I can tell you that if we were to do that, we'd make a lot more money. We want to help put you in a good position because when we do that, you're going to send 2 or 3 or 4 people our way, right? Like we don't, and you guys could probably run the meta on this. See what we spend on ad spend for my company a month. If you guys are in marketing, you guys will fall. If we spent $2,000 last month, that would be a lot. And we're probably only going to be marketing one type of program, and that's to bring in sales agents, because that's our biggest, what we need, right? It's not for clientele. Like our clientele, we've done really well with.
Gotcha. One other thing to just circle back a little bit further too, you mentioned business, or like time in business is really important. And if you're going to switch your name or something like that, just do like a DBA, or instead of starting a new whole entity. Does that work? Let's say you want to transfer to a completely different industry. Like let's say I'm doing marketing and websites right now. Let's say I want to open up a construction company. Can I just DBA, change the name of the LLC? Or switching the name is a simple, file a piece of paper, but can we switch like entire industries, or like where's the line drawn between like, okay, you need to open up something new?
That's a good question. I'd have to tell you, refer to your accountant or your lawyer. Here's why. Because there's something called a NAICS code, NAICS code. Okay. And I'm struggling off the top of my head to figure out where that's attached to. If it's attached to the EIN, then yes, everything would be out of balance. If it's attached to the name, it wouldn't. I'm pretty sure it is attached to the EIN. So if you're making a monumental swing like that, technically would it work? Yes. But just get it set up the right way. That NAICS code, and which is a big part of business credit, has to match and has to align.
Gotcha. What can you tell us about SBA loans?
Sure. SBA loans
like-
are
Not to cut you off, but also maybe for context, instead of just like, what is it? Like, that's kind of broad. We mentioned how each type of loan has a different use case, or it's like, could be treated like a separate tool. There's like, what is an SBA loan and what is like the proper use for them, or how would you
yeah, sure.
know that it's
So-
something that's the right fit?
Easy. SBA loans are good for buying a business. They're good for buying a property, and they are good for consolidating debt. I would not use them for anything else. Okay, here's why. SBA loans are typically 10 years for working capital, 20 to 25 years if there's a property or a business included. Right? It is one of your long-term lines or facilities. So let's say you were going to purchase vehicles with an SBA loan. I couldn't think of a worse use, because a vehicle you're probably going to be done with in 5 years. And if it's structured in a 10-year loan, well, now you're paying on something off and you have no benefit from it. So you're going to have 5 years of payments and you have no vehicle attached to that. Okay. So it's great for consolidating debt because it goes out to 10 years, but it won't pay off cash advances anymore. It won't pay off invoice factoring anymore. So it can consolidate credit cards and a bunch of like vendors and suppliers and that type of stuff. But that's what I would use an SBA loan for. Those are three things. Anything else is questionable.
Cool. All right, I know we're coming up on time, so let's round things out with this one last question. What's one thing that every HVAC or home service business owner should do right now to put themselves in a better financial position, whether they need money today or not?
Great question. Check your business credit. Look at the things that a bank is going to review, okay, and get them as strong as possible. 1, monitor your personal credit. 2, monitor your business credit. 3, make sure you have financial reporting where you can see your P&L every single month. All right. Make sure you're keeping that 10 to 20% in the income account at all times. All right. And then work with people, build relationships with people like myself that can actually help you and that give a shit and aren't trying to sell you. Right. Like I turn a lot of people off because sometimes I'm very, very blunt, but I'm blunt because I want to help you. Right. It's like you have a fat person in your life, and not that there's anything wrong with that, but if you pretend that this guy, your best friend who's 300 pounds, isn't going to die any day because he's going to stroke out or have a heart attack, you're not doing him any favors, right? And that doesn't mean you have to make fun of him, but you should be telling him, hey man, like I care about you. I want you to do well, but you got to handle this. We work the same way because if we just sugarcoat things, it doesn't get fixed. Okay. The idea is to improve a little bit every day. And then if you keep stacking those small daily wins, you build momentum. And that momentum builds a different person, builds a different business that operates on a much higher level. All right. That's really what the end goal should be.
Absolutely. Right on, man. I think that's a great way to kind of bow tie everything we talked about. If you want, let people know where they can find you at, website, names, social media handles. We'll have that all linked in the description below.
If you can just send that to us, we'll just link that in the description.
Yeah, I'll do one better. I'll send you a link to my podcast, Special One Building Business Credit. My websites are integratedbusinessfinancing.com or integratedfactors.com. On YouTube, it's Integrated Business Financing. On LinkedIn, Facebook, Instagram, it's just Jonathan Federa. And I'll get you guys my calendar too. So if anybody, needs help, has questions, they can reach out. Guys, we are super open. Like I said, I'm very blunt. As long as you schedule and you don't find my cell phone somewhere and blow me up randomly, that is my only pet peeve. Believe it or not, people do it. Doesn't matter how many shows I'm on. Someone will find a number, track it down, and do that. And that's the worst way to start off with me. So always just schedule or just shoot me a text or an email. Hey, I have this going on, and I'll give you the shirt off my back.
Cool. Right on, Jonathan. It was a pleasure. Thank you so much for your time, man. Really appreciate it. We'll be in touch and enjoy the rest of your day, brother. I appreciate the conversation. Right on.
Likewise. All right.
Bye.
Peace.